What's going on, Z community? It's me, Tamara Aziz. Today I'm going to be teaching you guys how to trade calls and put contracts on Questrade. So some key points that we're going to be talking about today are a brief overview of what calls and puts are, how to actually buy and sell these puts and calls, some strategies that go along with these type of trades, and some factors to consider with each type of trade. So without further ado, make sure that you're subscribing to the channel and you're pressing that like button, and let's get on with the video. So first things first, what are puts? So puts are one of the two types of options that you could either buy or sell with Questrade or even other brokers. When you're buying puts, you're basically putting yourself some insurance, because at this point you probably already own the stocks and you have a feeling that they might go down in value from where they are right now. You probably have a specific price in mind, and this specific price within the options contract is going to be called the strike price. You, who is the person buying the actual put, and the person who is selling the put, which is on the other end of this options trade, you guys are going to be both agreeing on this specific price point. If it hits this price point or goes below it, that means the person on the other end is going to buy these shares from you, which means that you're going to sell the shares to them at a lower price. To put it in simple terms, one man's trash is another's treasure, and in this case, the stock that you have, when it goes down in value, is going to be trash to you, but to another person is going to be a treasure, and that's basically what you're doing when you are buying puts. So let's just take a simple example to actually look at how this works. Let's just say that you bought a stock at, I don't know, $10 and now it's at $30. But you feel that now it's a little bit too high and you feel like it might skyrocket some more, or you feel like it actually might start going down in price. So what do? Well, you could do two things. The first thing you could do is the traditional thing, which is just sell the stocks at $30 per share and just call it a day. Or you can buy a put option against these shares. So let's just say when you are actually buying these put options, you're going to be putting a strike price of $25. This means that the maximum that you are going to be profiting is $25 minus $10. In this specific scenario, you might be okay with still selling the shares at $25 instead of $30. So what you would do now is actually put it at a strike price of $25. And on top of that, you would have to pay a premium of 50 cents per share, and the expiration date would be sometime 1 month into the future. I'm gonna keep these pointers on the screen while I explain the lingo that I just threw on you guys. Alright, so strike price. We already mentioned this a little bit before, but basically this is the price that both of you guys are agreeing to do the exchange of the shares. In this case, this is going to be that $25 that you're going to be selling to the other person, and the other person is going to be buying them from you at $25 per share. The premium, which in this example is going to be 50 cents per share, is the price that you're going to have to pay in order to actually make this contract a thing. This is basically a courtesy from your end, because you're basically telling the person on the other side, yo, okay, listen, I'll give you the shares for $25, but you're going to have to wait for a month, haha. So in order to actually compensate that other person for waiting that long, you're going to have to pay them the premium of 50 cents per share. And because each options contract is 100 shares each, that means you would have to multiply 50 cents by 100 shares, which is $50. You're going to be paying $50 out to the person on the other side who is waiting. And the last term that I mentioned is expiration date. The expiration date is pretty self-explanatory. It's when the contract or the deal that you guys just signed with each other is not going to be effective anymore. This expiration date will basically tell you whether or not you're actually going to sell these shares to the other person, or if you're going to keep them for another couple of weeks. In these next couple of weeks, that's when you could either decide to just sell them straight out, or you could just make another options contract. Now back to the example again, let's just say that your expiration date was April the 1st. April the 1st comes in and there's two things that could happen to you. Number one, the stock price can actually be over $25 still, or the second scenario is that it is under $25 per share. If the price is over $25, that means you are going to keep your shares and the other person on the other side is not going to be buying them off of you, because that was not in the deal whatsoever. The unfortunate thing is that the premium that you paid out to this person, which was the $50 that we just talked about, the person would have to keep them, because at the end of the day, they ended up having to wait for a whole month just to see what the result was going to look like. So in this type of situation, you still get to keep your shares, but you are giving out a premium to the other person. And from here you get to decide whether you want to just sell them outright or do another options contract. Now, if the price is under $25, this is a completely different situation. So no matter what the price is, as long as it's below $25, the person on the other end is going to be buying these shares off of you for $25 per share. Even if it's trading at $20, if it's trading at $15, or even if it's trading at $2 per share, you're still going to sell that stock at $25 being the price point. This is actually a good thing on your end, and this is why people buy put options in the first place. Because think about it like this. At the end of the day, let's just say that the stock price crashed and it's all the way at $5. You ended up actually limiting your losses because you are actually giving the person the stocks at $25 instead of $5. So think of it as a stop loss type of scenario, because at the end of the day, we don't know whether markets are going to go up or if they're going to go down. Alright, so the example that I'm going to be using is Toronto real estate. If you know, you know. Studies show that 20 Canadians cry every single day because of how overhyped and over expensive Toronto real estate is. And that's exactly why we're using it in this example. So let's just say that you wanted to move into a downtown Toronto condo that's probably the size of anybody's kitchen within the country. Anyways, listing price is $3 million. You tell the owner that, hey, you know what, man, I'm actually interested in buying this place, but $3 million is just way too much. So instead, the maximum that I'm going to be giving you is $2 million and that's it. As I'm telling this guy that, he's probably thinking in his head, you know what, nobody's going to buy this kitchen-sized condo from me for $3 million. And this is what he ends up saying. If I don't end up selling this house for $3 million by the end of this month, I'll sell it to you for $2 million. And just to keep you as insurance, I'm going to give you $10,000 to hold down while you're waiting for this 1 month. Do we have a deal? What are you going to do? Are you going to shake his hand or are you not going to shake his hand? I'm shaking his hand because at the end of the day, I get an extra $10,000, and on top of that, I can get a downtown Toronto condo for $1 million lesser than what was listed for. Anyways, 1 month passes and now we're left with two different scenarios. First scenario is that this guy doesn't end up selling the house to anybody for $3 million. So he comes back to you and he's like, you know what, let's do this deal. You can keep the $10,000, but I'm gonna need you to actually buy this condo off of me for $2 million, and that's that. Because you both signed on this contract, you both agreed to something, you're gonna have to buy the condo. And the second situation is that the guy ends up selling his condo for $3 million to some guy who doesn't know what's going on. And that's pretty much it. You don't get the condo, but you get to keep that same $10,000. Either situation is gonna be a win-win scenario. And the same thing applies with options. It's just instead of real estate, you're dealing with 100 shares of stock for each contract, and that's pretty much it. If you still want more clarification about how buying or selling put options work, let me know in the comment section down below or shoot me a text at the number that you see on the screen. Now let's move on to calls. So when you're buying a call, you're actually going to be the one who's forcing the person to sell you the shares that you want. You would end up doing this because you're hoping that the shares actually increase in value by the time that you would end up buying these shares from someone. For example, if a stock is at $10 right now, I know that it's gonna go to $30 for sure. So I end up buying a call contract for, let's just say, $20. This means I would buy the shares at $20, and once it hits that $30 mark, then I just sell for profit again. And again, because you are buying a call contract, you still have to pay a premium in order to actually keep the benefits that you can get from these type of contracts. Let's just take an example of Airbnb and when it IPO'd on the stock market. IPO is just another way of saying the initial price offering, and this is when a stock makes its debut into the stock market. This is its first day that it becomes available for everybody to buy and sell. The reason I'm saying this is because usually IPOs have a history of being super high when they first come out, and then within weeks they just end up decreasing. Airbnb actually did the exact opposite, which is why I'm using it as an example for buying call options. Let's just say that Airbnb made its debut at $20 per share, and you think that it's fair to buy this at $25 per share, assuming that it's going to be showing you signs of skyrocketing, basically. This means that you would buy a call option at a strike price of $25 per share. And the expiration date, you can make it whatever you want, but just keep in mind that the more longer the expiration date is going to be, the more that you have to pay out in premiums. Anyways, fast forward to whatever expiration date that you ended up picking out, and you're gonna be left with one of two situations. The first situation is obviously the stock is higher than $25 or the stock is lower than $25 as usual. So if the stock ends up being over $25, this means that you can go up to the person who has the shares and be like, yo, listen, send me those shares for $25, my G. Even if the stock's trading at $50, $75, $100, you're gonna end up buying these shares for $25 per share. Pretty good, right? Pretty good. This means that with buying call options, you basically have an unlimited amount of profit potential, which is pretty awesome. Even though you do have to pay a premium to actually do this, I think it's very much worth it if you see a lot of potential within the one stock or ETF or whatever the case may be. Now, the other case scenario where the stock ends up being under $25 still. Now, because you're on the side of actually buying the call contract, you have the power to basically buy the stocks or not buy them whatsoever. And it wouldn't make any sense for you to actually buy the stocks if they're under $25, because that just wouldn't make sense whatsoever. You're not going to be facing any penalties for not doing anything about it. The contract is just going to expire, and that's going to be pretty much it for you. Now, the only thing that you are going to be losing in this type of situation is the premium that you paid out to the other person. Regardless of the outcome, the person on the other side ends up keeping that premium. Now let's just flip it over and see how it would look like if you were the one who was selling call options. When you're selling call options, you're basically the one who's going to be forced to sell the shares that you already own to somebody else. So basically, as soon as you sell this call option, you're basically hopeless and you have to hope for the best. What are you going to be hoping for? You're going to be hoping that the actual price of the stock does not go any higher than the strike price that you and the other person agreed on. Let's take a look at an example with some financial terms, but be sure that you're with me here because, yeah, I'm going to be using all the terms that we've just learned in the past, okay? So bear with me. Boom. I just bought 100 shares of stock for $100 a share, okay? It's trading at $120 right now, but I think it's kind of overvalued. So what do? Now, of course, I could just sell it and make profits right now, but instead, I want to get some extra income by getting some premium off of this type of contract. Z community, okay, I understand not everybody is gonna have the time to watch a 10-minute video on YouTube, which is why I made TikTok. Literally videos within less than a minute and even times less than 30 seconds, you could be getting so much value. So check out our page on TikTok and let me know what you guys think. Be sure that you send me a follow, and I've also got a Q&A section over there in case you had any questions. Alright Z community, enjoy the rest of the video. So anyways, I sell a call contract. $120 strike price. Let's just say the premium is at 50 cents per share again. An expiration date, again, it's gonna be up to you. Let's just say April the 1st. Let's make it simple. Now we fast forward to April the 1st, and these are the two types of situations that I could find myself in. Situation number one is if the stock price is over $120. Chances are if the stock is trading at more than this amount, the person on the other side is gonna be like, yo, you know what? Send me those shares, send me those shares. You're going to be basically forced to sell them the shares at $120, but you get to keep the premium. And as we said, if the premium is 50 cents and I had 100 shares of stock, 100 shares of stock multiplied by 50 cents, I get to keep $50 from this guy. The second type of situation that I might find myself in is the stock price actually being lower than $120. In this type of situation, nothing would basically happen. The other person on the other side wouldn't say, give me those shares. I'd end up keeping the shares, and on top of that, I get to keep the premium of $50 as well. Now that we've done a brief overview on how buying and selling calls and puts work, let's actually go over to Questrade and see how to do this in real time. Alright, I'll see you guys there. Alright, so boom. First thing you're going to do is log into Questrade. Second thing you're going to do is, give me a second, you're going to find this screen. Bang. Alright, we got the screen on here. So first things first, you're going to see this page as soon as you log in. First thing that you're going to do is go to this top left corner beside the Questrade logo, click it, and then click on trading. Alright, now that we're actually on the trading tab, you are going to still stay at that top left corner where it says symbol lookup. You're going to tap that, but first you're going to tap on OPT. This indicates that you are going to be buying or selling an option. Then you're going to actually type up a symbol, and let's just say in this type of situation it's going to be Air Canada. Then what you're going to see here is the options chain popping up. Now, please forgive me because every single time that I record a video that has to do with options, I'm always here on the weekend, and you guys don't ever get to see like the bids and asks and how it actually looks like in real life. But it looks about the exact same. It's just we're missing the bid and ask numbers over here. Oh yeah, and what I meant by options chain is that it's just a financial lingo for just a description of the different prices for different options. It shows you the Greeks, shows you a bunch of different things. Now, if you're going to be buying puts, you are not going to be paying attention to the left side of this options chain whatsoever. Because as you can see over here, the left side of this is calls only. The right side of this are the puts. Now, depending on which type of strategy you're going to be using with puts, you're either going to be paying attention to the place that is highlighted in white, or not highlighted at all, sorry, and then the place that's highlighted in green. Well, whatever, once you've made that decision, then you're going to click the price that you're comfortable with, and then after that, you're going to see it pop up over here, your Greeks, implied volatility, all of that good stuff. Don't worry about that too much for now. This will probably be for another video, but you're going to press buy and sell. You're going to see the right side window come up, and this is where you put all of the details for your order. Now, because we picked a strike price of $27.50, we're going to make sure that it actually says that over here. So for example, options type, boom, they already messed up because I wanted to do a put, remember? This is why you always have to double check your orders before filling them in. So we're going to switch this over to put. But if you have different types of strategies that you have in mind, such as a vertical call, vertical put, calendars, diagonals, straddles, strangles, all that other good stuff, you can just pick them over here and then it'll give you the options for that. But for now, we're just going to be doing a simple put. Quantity is going to be 1, which is equal to 100 shares. And then you're going to verify that the information that you put here was correct. So we said $27.50, so we're going to change that up for a put. And expiration, let's just say April the 1st. The order type over here, let's just say a limit price. Now, the limit price that you're going to be putting over here is really going to depend on what the bid says and what the ask says. But whatever the bid and the ask price is, you're just going to be putting down the price, which let's just say is like the 50 cents that we were talking about in our example. And then you're either going to be pressing buy or sell. Obviously, mans don't have the funds right now, or the market's just not open. Yeah, no, mans just don't have the funds. So you're obviously going to review this. You're going to either press send order if everything looks right, or you're going to press do not send. And that's pretty much it on how to actually place the put orders. Oh yeah, so just before we move on to how to do the calls aspect of this, I wanted to show you over here when you're doing puts, or especially when you're buying them, the types of strategies that you would probably want to use are the straddles, the long or short callers, which for some reason is not here, vertical puts, calendar puts, as well as diagonal puts. There should be butterflies and condors here as well, or even iron butterflies, but I don't see that over here. It might have to be one of those manual ones which you could press by clicking custom. Now let's move on to the actual calls itself. Everything that we just discussed is literally the exact same as to how to actually buy or sell a put. It's just the difference is now you're going to actually press call. And conversely, the different types of strategies that you can use with calls are obviously the vertical calls, the calendar calls, diagonal calls, and the other types of calls that we just mentioned earlier. Now, the only difference is that with calls, we are now going to be paying attention to the left side of this options chain. The left side of the options chain will show you what is good in the hood. But for real though, with calls, because we discussed that you can either buy calls or sell calls, I wanted to let you guys know that the part that is highlighted in green, this is going to be the area that you will be focused in if you are going to be buying the calls. The area that is highlighted in white is going to be your main focus if you are selling the calls. So let's just say that we wanted to sell a call. If we wanted to sell a call at, let's just say $27.50, you're going to press buy. It's going to pop up for you over here. Go through it to make sure that everything looks good. Make sure it's a call. Make sure it's only one quantity or whatever quantity that you want. And then for the limit price, you're just going to put the 50 cents that we were talking about before. You're then going to press sell, confirm all of the information that's here. If it looks good, press send order. If it doesn't, press do not send. And before we close this, right over here where it says trade value, this CR $50 Canadian thing is the premium that we were talking about earlier. If you notice, when we try to do the actual buying the calls, this doesn't show as a credit. It shows as a debit or debt, whatever you want to call it, which means that you're going to be paying it out instead. So let's just look at the example of buying a call. Let's just say $25.50. You're going to press buy or sell. Obviously confirm everything is looking all good in the hood. Put your limit price for the premium being 50 cents. Press buy this time and watch the difference over here. Trade value is going to be $50 Canadian. Because it's not a credit, means that it's coming out of your pocket, you're not receiving it. So you're going to be paying all of that. Make sure it looks good. If it does, press send order. If it doesn't, press do not send. And that is how to actually sell calls and puts on Questrade. Alright, so some general notes that you need to keep in mind before you actually buy or sell calls and puts. There is something called an assignment fee that Questrade will charge you, which is $24.95 for every single time that an option gets assigned. Assignment is when the person from one end of the deal decides to exercise their option. Exercising is just a fancy way of saying when the other person ends up wanting to hold their end of the deal. For example, in the puts and calls that we've talked about before, this is when the person comes up to you and says, hey, can you give me those shares now? Or when another person comes up to you and says, yo, I'm giving you my shares now. This is basically what exercising means, and when you're on the other end who is complying to what they're asking you, that is called assignment. So if you were thinking of actually assigning or exercising an option, I'm going to show you a quick way on how to do it on Questrade right now. So we're continuing back off at the options chain where we last left off, but this is not where you exercise your options contracts. Instead, you have to go to the top left corner beside the Questrade logo and press on trading, but then click on accounts this time. And then what you're going to do is you're going to still pay attention to this top left toolbar where it has the Questrade logo. You're going to go all the way to the right where it says requests. Under requests, you are going to actually click on exercise an option. You're going to click on that, and then a screen is going to pop up for you where it asks you for all the information that you need to actually put in. So for example, you put in the account number, whatever, you put in either exercise or expire worthless, the expiry month, whatever, April, and then you put in the quantity, the option symbol, the security, which is like the ticker symbol of the actual stock, expiry year, the type, strike price, whatever. Now, basically you just fill in these things and that's pretty much it. And one last caveat about actually trading options with Questrade. So if you have an RRSP or a TFSA, or also known as registered accounts within Canada, you can still trade options, don't get me wrong, but only up until the level 2 requirements. Now, because what I mean by this is Questrade breaks down options trading into 4 different levels, which you have to sign up for each and every single one. Some of them have different types of requirements, but when it comes down to the TFSA or the RRSP, level 2 is just the maximum that you can go up to. After that, you have to do this in a non-registered account, or what Questrade would like to call the margin account. Now, in order for your account to be a level 2, there's no minimum balance or anything that you need to put in. You just have to sign a form, tell Questrade, hey, yo guys, I'm gonna start options trading now, just letting you guys know. That's pretty much it, you're good to go. But when it comes down to level 3 and level 4 of options trading, there's more of a heftier requirement there. These are mostly just having actual balances of whatever they want. I think level 3 might require you to have $5,000 in the account, and then level 4 require you to have $25,000, something along those lines. But if you have a registered account, level 2, that's it. So in order to actually get these option levels up and running, let me show you how to do that on Questrade real quick. Let's go. Alright, so we're back where we started with the actual exercising an option. But in this case, if you want to upgrade your options level, you're going to highlight your cursor over account management, and then you are going to actually click on account management. It's going to bring you to a page where you could actually edit your options level. As you can see, it'll tell you all your information. Okay, cool, that's pretty cute. And then you'll see over here option level. Level 2 is what I'm at right now. I don't feel like I need to go anything higher, but you could press on change and then it's going to pop you up another page where you could actually click on the different level that you are trying to get. Once you actually want to do this, you're gonna click on your options level, press submit, and then you're gonna have to fill out a form, electronically sign it, and then send it over to Questrade for their approval, which will take anywhere between 2 to 3 business days. Now, Z community, if you're still new to the options world, be sure to check out one of the past videos that I made about me making the craziest mistakes. Make sure that you don't make that same mistake. And Z community, question of the week is, what type of options are you going to be buying and selling on Questrade? Me personally, my favorite is selling calls and sometimes selling puts. Let me know what you guys think in the comment section down below, and I'm loving to have a conversation with y'all. If you found value from this video, make sure that you're tapping that subscribe button and liking the video and pressing that notifications bell to make sure that you're caught up with all of the new content. Anyways, this is me, Tamer Aziz, signing out. Peace.